Welcome to Dual Edge Research, where we provide disciplined, data-driven strategies designed to help investors succeed across multiple markets. Dual Edge Research publishes two powerful newsletters that work great individually and even better together. The Bull Strangle newsletter focuses on stocks and options, combining stock ownership with premium selling strategies to generate consistent income and market-beating returns. The Smart Spreads newsletter specializes in seasonal commodity future spreads, offering a diversified approach with low correlation to equities. Together, they deliver a complete investment perspective, one focused on income, the other on diversification, all under one simple subscription. Two powerful strategies, one disciplined source, Dual Edge Research. This video will focus on the Bull Strangle newsletter, a disciplined, structured approach designed to generate consistent income and long-term performance through a balanced combination of stock ownership and option selling. In this video, we'll take a closer look at one of the most important concepts in options trading, the difference between option selling and option buying, and why the Bull Strangle framework is built entirely around the advantages of selling premium rather than speculating on price direction. By the end of this presentation, you'll understand how the Bull Strangle strategy captures steady returns in a wide range of market conditions, how volatility plays a role in premium income, and how the method maintains discipline week after week. Before we jump into the options selling topic, which is just a small part of the Bull Strangle strategy, you can learn the entirety of the strategy on our YouTube channel. Just search Bull Strangle Newsletter and you will find a comprehensive set of videos that explains the strategy in detail. In this four-part video series, we'll take you through every aspect of our proven strategy. We'll start with a fundamental options overview, then dive deep into our core strategy, I'll explore risk optimization techniques, and finally show you how our newsletter can help implement these concepts in real-world trading. At the heart of our approach is a powerful three-part strategy that combines stock ownership with both covered calls and cash-secured puts. This integrated method creates multiple income streams while managing risk effectively. By selling out-of-the-money calls and puts 4 weeks out, we create a systematic approach to generating consistent returns. Now, let's dive into understanding stock options. We'll explore what they are, how they work, and the key concepts you need to know for successful options trading. An options contract gives you the right to buy or sell a specific quantity of stock at a predetermined price before a set date. Let's look at an example using Apple stock to understand this better. In this example, we are buying an options contract on Apple. Specifically, this gives us the right to buy 100 shares of Apple at a price of $210 for expiration on August the 16th. Let's take a moment to break down the basic structure of stock options. On this slide, we're looking at the two types of options, calls and puts, and the two sides of every trade, the buyer and the seller. Starting with the call option buyer, this person has the right to buy a stock at a specific price known as the strike price. They're hoping the stock moves higher, so that right becomes valuable. The put option buyer, on the other hand, has the right to sell a stock at a certain price. They benefit when the stock declines in value. Now let's look at the sellers. The call seller takes on the obligation to sell the stock at the strike price if the buyer exercises their right. Similarly, the put seller has the obligation to buy the stock if the buyer chooses to exercise. In short, option buyers pay for rights, while option sellers receive premium income in exchange for obligations. Understanding this simple framework, rights versus obligations, is the foundation for more advanced strategies like covered calls, cash-secured puts, and the Bull Strangle approach we'll discuss later. This slide shows a simple example to highlight the key difference between buying and selling an option. Here we have Jack, the option buyer, and Jill, the option seller. The underlying stock in this example is Groupon with a strike price of $40 and an expiration date of August 1st. The option premium is $2. Jack, as the buyer, pays the $2 premium to Jill. In return, he gains the right to buy the stock at $40 before the option expires. He's hoping the stock rises above $42 so that he can profit after covering the cost of the premium. A Jill, on the other hand, is the option seller. She collects the $2 premium up front, but takes on the obligation to sell the stock at $40 if Jack decides to exercise his right. Her best outcome is for the option to expire worthless, so she keeps the full premium as income. This example shows the fundamental trade-off. The buyer seeks leverage and unlimited upside potential, but risks losing the entire premium, while the seller earns immediate income but accepts a defined obligation and potentially unlimited risk. Understanding this relationship between the buyer's right and the seller's obligation is essential before moving on to more advanced strategies like the Bull Strangle, where we use option selling to generate consistent income. Let's start by looking at how option buying works. When you buy a call or a put, your potential loss is limited to the cost of the option, but your upside can be very large. At first glance, that might seem like the better deal: limited downside and unlimited potential gain. However, as we'll discuss later, buying options carries a hidden cost that works against most traders over time: the cost of time. Now, let's flip the picture and look at option selling. When you sell options, your profit potential is capped at the premium you collect, while your losses could, in theory, be unlimited. At first, this may sound risky, but there's a key advantage: time is on your side. Every day that passes, option value decays, and as long as prices stay within a reasonable range, the seller keeps that premium as profit. This fundamental difference between buyers and sellers sets the stage for how professional strategies like the Bull Strangle generate consistent returns. Next, it's important to understand the terms in the money and out of the money. An option is in the money when it has intrinsic value, meaning the option would be profitable if exercised right now. A call option is in the money when the stock price is above the strike price, while a put option is in the money when the stock price is below the strike price. Conversely, an option is out of the money when it has no intrinsic value: a call when the stock is below the strike, or a put when the stock is above it. The difference between the strike and market price defines intrinsic value, while the rest of the option's price reflects time value, the market's estimate of future potential movement. Here we can see how intrinsic and time value combine to make up the total option price. The left example shows an option that is in the money because the stock price is $40 with a call strike of $38. In this scenario, the option price is $4 with $2 of intrinsic value and $2 of time value. The middle example shows an option that is at the money because the stock price and the strike price are both $40. In this scenario, the option price is $3 with $0 of intrinsic value and $3 of time value. The right example shows an option that is out of the money. In this scenario, the option price is $2 with $0 intrinsic value and $2 of time value. Notice how at the money and out of the money options consist entirely of time value. Option buyers must pay that premium up front, while option sellers collect it. That simple concept explains why time decay consistently benefits sellers, and why the Bull Strangle strategy is built on option selling rather than buying. This slide summarizes what typically happens over many trades. Option sellers, especially those selling out of the money contracts, win about 60 to 75% of the time because most options expire worthless. Option buyers, on the other hand, have a lower win rate, around 30 to 40%, but their occasional winners can be large. The key takeaway: sellers enjoy a statistical edge driven by time decay, while buyers rely on predicting large price moves that don't happen very often. That's why market makers and institutions tend to be net sellers of options, while retail traders are usually on the other side of the trade. Here's a quick comparison. Option buyers aim for big directional wins. They need significant price moves to profit. Option sellers, on the other hand, look for price stability and profit from time decay. Buyers experience small losses frequently with the hope of an occasional large win. Sellers experience small, steady gains most of the time, with the possibility of an occasional larger loss. The Bull Strangle Strategy is designed to manage those rare larger losses while capitalizing on the consistent income generated from selling premium cycle after cycle. This final slide shows actual results from trades since February 2024. Across 386 trades, the strategy achieved 284 winners and 102 losers, a 2.8 to 1 win ratio. Average gains were about 12% and average losses about 18%, resulting in an overall average return of 4.1% per trade. While past performance doesn't guarantee future results, these numbers illustrate the consistency that comes from following a rules-based approach, combining long stock positions with disciplined option selling. That's the essence of the bull strangle: structure, discipline, and probability working together over time. Looking for consistent profits in both stocks and commodities? Now you can get 2 powerful newsletters for one simple price. For stocks and options, the Bull Strangle newsletter shows you how to combine stock ownership with dual option selling, a disciplined strategy that has consistently outperformed the S&P 500. For commodity futures, the Smart Spreads newsletter focuses on seasonal commodity spreads, a proven low-correlation approach that thrives in all types of markets. Each newsletter is designed to deliver consistent income on its own, but when used together, they create a complete diversified trading approach that works in any market environment. Subscriptions start at just $49 a month, with deep discounts on 3-month, 6-month, and annual plans. And right now, for a limited time, your first month is only $1. There's no long-term commitment, cancel anytime. So don't wait. Visit bullstrangle.com/products. That's bullstrangle.com/products. And start trading smarter today with the Bull Strangle and Smart Spreads newsletters.